Okay. Seller exchanges. Sam, who you want to call in?
I'll read it.
Go ahead.
Gain or loss calculation. The amount of gain or loss realized by a selling partner is equal to the difference between the amount realized on the sale and the seller's adjusted basis for his or her partnership interest.
What's my favorite definition?
You got a lot of them.
Proceeds. What is it?
Oh, cash, property, debt relief.
Cash, property, and debt relief. So it's cash, property, and debt relief as compared to somebody's adjusted basis, correct?
Yes.
Okay. What we got next?
Amount realized includes cash and debt relief.
Okay. So this is worth, go ahead and read the last one, then we'll come.
A partner is treated as only having a single basis, even if the partner is both a general and limited partner.
Okay, we've said that before, right? Does that seem familiar? Anybody?
Sure.
Can we talk about that, I think?
Yeah.
Okay. So if we have acquisition cost for A of $100, and we have a balance sheet, cash $100, debt 50, A, B 25 and 25, 100 and 100, correct? Everybody with me? Okay. If you exclude debt basis, what is A's basis? Sam?
25.
If you, oh, fuck me. Yeah, good call. 25. Because I don't want an inside-outside basis difference. Okay, so those are equal now, right? If you include debt basis, how much is A's debt basis?
25.
25 for a total of
50.
50. Okay, so we have 25 of debt basis, 25 of regular basis for a total of 50. Let's go back to point 2. What's point 2 saying?
Amount realized includes cash and debt relief.
Okay, so I'm going to say that A is going to be selling for cash their interest for $100. So what is my favorite definition of proceeds?
Cash, property, debt relief.
Cash, property, and debt relief, correct?
Yes.
And how much cash did I say A was selling for?
100.
100. Do I have any debt relief?
Do you get any?
Is there any debt relief that's going to be proceeds? Okay. I'm gonna, for purposes of this discussion, I'm going to say no too. Okay. And do we get any property? So we have 100. Total proceeds. Basis I said was what?
25. Or just
Well, which one do you want?
25.
25. I'm going to stick with that. Gain
75.
is 75. Okay, what's this say?
The bottom one.
Nope, the second one.
Amount realized includes cash and debt relief.
Okay. Do you think there might be debt relief in the middle of this somewhere? How much?
25.
25. And how do you arrive at that?
Because I have the debt.
Half the debt. So my debt relief is 25, correct? But what's my basis now? Well, hold on. My proceeds is 125, correct? Basis is 50. Does my gain change at all? It doesn't. So, in general, the gain loss calculation, you can include debt as part of proceeds, but you also have to include in basis. You can not include debt in proceeds, but you don't get to take that basis into your basis. But you get the same gain loss calc either way.
It doesn't matter.
Well, it does, actually. And my preference is just say, what did I receive and what's my basis versus including or not including debt. The big deal is if you have 751 hot assets, that could affect your hot asset basis calc. If you have hot assets, it's possible. So I still ignore it even though it could affect hot assets. Okay? Sam, who you want to call in? Brad, what's this say?
Taxability of sale or exchange. Any gain or loss recognized by a partner upon a sale or exchange of all or a portion of his partnership interest is generally recognized and treated as gain or loss from the sale of a capital asset under 741.
Okay, so 741 says the sale or exchange of partnership interest, the sale of a capital interest, a capital asset, unless there is, Brad, it's not up there. Noodles?
A rule that says no.
Says not. Noodles?
Hot assets?
Hot assets. 741 says, if you look at the actual language of the provision, 741 says the sale or exchange of a partnership interest is a capital asset. It will be a capital gain unless there's hot assets. And I'm sure that Mr. Kenny and Mr. Miller probably point this out at some point in here. And partnership interest considered long-term if held more than 1 year. That's no different than any other rule. Brad, what's this say?
Taxability of sale or exchange. Exceptions to when the sale is not capital transaction. When the distributions include 751 assets, which is ordinary, collectibles, which is 28, and 1250 gain, tax 25%.
When the distributions include. Wonder why it says distributions include, Kenny. That might be a jackass.
Why do you say that?
Except for when the sale is not a capital transaction. In my mind, either it's a redemption, which is a surrendering of the units back to the partnership, or it's a cross purchase. Either one is going to be a sale or exchange of a unit. And the words on here that were chosen, when the distributions include, I assume that means that that's a redemption. I'm just curious at the words.
Sean Miller probably wrote that slide.
Probably have to be. Yeah.
100%, Sean Miller.
Yep.
Okay, so, and the fact, this is actually irritating to me. I mean, legit irritating. Because maybe I was wrong that rule didn't exist. Brett knows not, why am I
Are
irritated?
you going
Brett?
back to the 8308?
I'm going back to the 8308. I mean, 8308 has been revised to include these items. Mr. Kenny and Mr. Miller wrote this in 2011. So is it that in 2011 I was stupid and didn't know this rule? Is that possible?
Yep.
Sure is. So what this is inferring is 751 assets, collectibles, and 1250 on the sale or exchange of partnership interest should be captured as part of your gain calc. And I never did that and never recognized that up until the change in the 8308 form. So maybe I was wrong. Maybe. Does that seem familiar to you, Kenny? I mean, in my mind, the sale or exchange of partnership interest is capital, unless there's hot assets. What this is inferring, and it's congruent with the new revised 8308, is that, well, wait a minute, not only do you have to stop and think about capital assets, or 751 assets, you have to look through to the partnership balance sheet and figure out what would be taxed at 28% as a collectible and 25% for under-captured 1250. That's what this says. That's what the new 8308 is doing, and I'm surprised by that. I'm surprised I didn't know that, and I'm surprised.
What are you saying you didn't know?
I would have said that only 751 was.
It's unrecaptured 1250, not 751.
Nope.
Who wrote this outline?
You and Miller.
We really did?
Yeah.
Okay.
I thought that was. I thought you were always looking through to the underlying
I thought
assets.
that was just an example. I thought you were this was like a test case.
No.
Okay,
You and Lil Miller did this.
all right.
I thought you were always looking through to the underlying assets of the partnership. Anytime you're transacting on the partnership units.
I only do that for hot assets. And under capture 1250 is not a hot asset. And neither is a collectible.
I can see where, well,
So you think we've missed this a few
but,
times?
but anything that.
1,000 or thousands
Yeah.
of times. And how many times do I think we're going to continue to miss it?
How often do you think we file that Form 8308?
We should be filing anytime there's a sale or exchange of an interest to avoid, because there's a penalty for not filing it.
Is the
I think.
requirement that you have to file that only when there's those things? If it's pure capital, you're not required to file it?
Yeah,
Isn't
that's
that
right.
right?
That's right. At least that used to be the rule, but I've stumbled at least 4 times or 10 times so far in stuff I didn't know, and there's been a curveball thrown at me in here. So the fact Kenny has that there, I find that disturbing that I didn't know that rule, and that the 8308 isn't an overreach as I was stating it, I thought it was, and maybe I've been wrong since 1996, which is not comforting.
Why are you using an outline that Sean Miller prepared for this class?
Because either I could have taken this shit and put it into new slides, or I could just use these. And I wasn't going to do it. I could have had admin do it, which.
Well, I was impressed you had something typed out, so I was
Oh,
curious.
no, there's been lots of second grade art. 8308. Okay, we don't care. We've talked about that, right? Okay, so this must be specifically, they were talking about redemptions. Guaranteed payments to partners under 736 or ordinary income to the retiring partner and deductible by the partnership. So there's a rule, which I don't think, I'd be surprised if Mr. Kennedy ever followed it. I've never followed it, because there's always a presumption that if you have A, B, and C, and dollars are coming out to A, and units are being surrendered by A, there's a question that's supposed to be asked as to what is the origin of that payment. Is it for the units, which should be capital? Is it a guaranteed payment that is just being classified as a payment to that partner? I mean, it's possible that this redemption is not treated as a capital transaction. And I'm not able to really articulate when you trip over that wire to go from being capital to ordinary and them calling it a guaranteed payment, because I've never followed that rule, and I'm not going to follow that rule, because I can't fathom when it would exist. And what I've read about it briefly, it has to, I think, more with service, provide a service-oriented business such as accounting, legal, and otherwise that says it's ordinary. I don't know, and nor do I really care.
Don't you think you'd have to look at the fair market value of the partnership interest? And maybe if you paid more than that, then maybe there's some compensation element?
Well, that'd be fair, but I don't think that's where, and maybe that is what it is, Kenny, I have no idea. But that would fall under my ordinary, I mean, if I knew it was worth $100 and somebody was getting $1,000, that would be its own discussion by itself to me. Because you're getting something more than the value of something that you'll hold in your hand. And what's 61 say, Sam? Code section 61?
Big Q, big Q. It's, hold on, wait.
What did you just say?
Good question.
Oh, okay.
Everything's income until it's not.
Everything's income till it's not. Okay? So if the way Kenny's describing that is, well, if the partnership interest is worth 100 and you're getting 1,000, what's that additional 900? And you got to give that a name. I think it's what you're saying. Okay, basis. Do we really need to talk about basis? Okay, I didn't think so. Well, yeah, I'll leave that alone. Holding period. So let's talk about holding period. And this has more to do with just recognition, because generally a partnership interest 9 times out of 10 or 99 times out of 100, nobody's going to do an analysis to figure out the holding period of the partnership interest. If I've been a partner in the partnership since 1980, then I'm going to have a long-term holding period. But if that's true, and let's say dollars are contributed and units are issued, first of all, Brett, what rules turn on if that's the case?
$704.
How do you feel about that, Sam?
754.
How do you feel about that, Alyssa?
So it's money for units,
Yeah?
704.
Kelsey?
704.
Said money for units 704.
Noodles?
Yeah, 704.
Brad?
Mm-hmm.
Brett?
Yeah, I said.
Oh, you said
I
you did,
started with
sorry.
704.
Sorry, I did start with you. It's 704.
Earlier you said 704. Okay, so it doesn't have to be a new partnership.
No.
It's just a new
It-
person.
No, I said the issuance of new units.
Ah,
That's what I said.
okay, thank you.
It was the issuance of new units. So, if dollars come in and additional units are issued, and then we sell, the partnership sells all its interest the very next day, do I have 2 blocks? I mean, this is where I get confused. It says I have one homogeneous bucket of basis. That's the rule that it said, correct? But now, part of that, I have new units that were issued the day before. Do I have short-term units? Is everything still long-term? It feels like I have short-term units that I have to contend with, to me. So that's one thing.
Wouldn't A measure that at the individual level?
They would, but, so yeah, I mean, I think you'd have short-term on a portion of it. Then, the other thing that this is saying is that if A contributed cash of 100, AR of 100, land from 1980 of 500, this is all fair market value, it would say, and it's worth $1 a unit. I think this says you have short-term assets of cash of 100 units, short-term units for AR of 100, long-term units of 500, because that's what the ground is worth. That's what that would say. And I think that's what that point 2 is trying to express up there. I think that's what I just said, right? A partner that contributes capital assets or 1231 allowed to tack the holding period to contribute assets. That would be the land in that example potentially. Non-capital assets, non-1231 has a fresh holding period, which would be my cash and my AR. A partner that acquires an interest by contributing both 1231 and non-capital assets, non-1231 must fragment its holding period. So according to Kenny, who's much better at 8308 than I am, and seems to have a better knowledge, says that you do have to bifurcate your holding period in between short-term and long-term, which makes absolute sense to me, which means that going back to my cash going in, this is where I trip up every time, homogeneous is all in one bucket, or the basis is homogeneous in one bucket, but you have different holding periods, so it feels like 2 different buckets, but whatever. Okay? Oh, this is a good one to have in here. Brett, who you want to call in?
Leslie.
Closing of the books, 2 methods to determine selling partners' income for the period. Interim closing of the books, so you close the books at the end of date of the partner exit, and then pro rata, allocate portion of income to exiting partner.
Okay? So, which of those, Leslie, do you think is the required method, and which of those do you think is an elected method? There's 2 methods up there. One is the closing of the books, and one is pro rata. One is required, and one is elected.
I wanna say pro rata is required, just because the amount of like S corps is, was it per day, so that's pro rata,
S corp would be a pro rata per share per day.
so that's my guess, is pro rata is required.
Yeah, that's your guess. Well, partnerships are the exact opposite.
Alright,
Okay? The rule is when a partnership has an exiting partner, you have a mandatory closing of the books that has to occur. You can elect to have it be pro rata. Mr. Kenny, which one do we generally do?
I don't know. The easy one is a pro rata. I think it depends if you got a fluctuation of income during the year.
But generally we do just do pro rata. I mean, we almost default to that.
Probably.
And maybe I'm misreading that.
Probably, but if you got any seasonality to your business, I mean, it could be.
You would clearly have closing of the books.
Yeah. And to do pro rata, does everybody have to agree to that? I can't remember that rule.
We really don't even ask, but yes, you're supposed to have agreement.
Because somebody could get a bad answer or a good answer, depending on
Correct.
what method is chosen.
Correct. But I think we sometimes are not the most diligent at getting that, because in a S corp, what did you say the default rule was?
pro rata.
Pro rata.
Share per day.
And there was do you remember the election?
For S corps?
Yeah. Kels? Anybody? What?
1377.
1377.
1377.
There's a 3 in there, a couple of 7s for sure, but I can't.
There was a double digit.
1377.
Okay.
The 1377 election. And does anybody remember the reg section? 1.1368-2G. And that is where you have the issuance of stock in the corporation to a new person. I think it has to be 25% of the outstanding stock when it's done, and then cross purchase of at least 20% or something along those lines. I can't remember. That also allows you to close the books for S corp. But 1377 or 1.1368-2G is an affirmative election to close the books for an S corp. You have to make an affirmative election, or the default is a per share per day basis or pro rata. A partnership is the complete inverse. You have a closing of the books is the default, and you have to elect a pro rata. And there is no form, at least to my knowledge, that says or requires a filing for making the election to do pro rata versus an S corp. You actually have to do an affirmative election that's attached to the return, signed by all the shareholders, to make sure that everybody's on board with that allocation or with the closing of the books.
Do you want to give them a history lesson on how you used to have to report this on a partnership tax return?
No, I have no idea what you're talking
Well, it
about.
used to be when you had to close the books, you had to file 2 separate tax returns, didn't you? I think you did. I think you had to have a short period return, 2 short period returns.
What year was that? And I don't remember that at all, honestly.
I don't know. It's over 10 years ago when everybody was in school in here, except you and me.
I don't remember that.
I think you did. And now you don't. It's easier, clearly. It was a real pain before.
I remember the 708 termination of partnership rules going away, which was a big pain, and that would generate 2 filings. But I don't remember,
Maybe that's what I was thinking. I might be confused on that.
okay, just the exit of a partner. I don't remember that. But what Mr. Kenny's talking about is, I can't remember what year that went away. Sometime post 2005, because I was at Lutz when that rule went away. There was a rule that said if they're a partner,
If you had a more than 50% change, wasn't it? Okay.
yeah, a more than 50% change in the ownership interest of the partnership, it was called a termination of the partnership, or is that the right word?
Technical termination.
Technical termination. That, I was missing the word technical. Technical termination of the partnership, which said that the partnership ceased to exist, even though it didn't. So Steve and I are partners with Brett and Alyssa. Steve and I own 51%. We leave the partnership. You two still exist as partners. The old technical termination rules would say that our partnership with the 4 partners ceased to exist for tax purposes, and you had a new partnership that started for you two, even though you two never exited. So there was only one thing that was really, really bad that 2 things. 2 things that were bad that happened if you had that rule inflicted on you. Thing 1 was what Steve just talked about. You had a terminal point for that partnership, you had to file a return, and then you had a new partnership with just the 2 of you in that partnership. The second thing that happened, and these rules don't exist anymore. What's the second thing I'm going to say? Do you remember?
Tax attribute carryovers.
Nope. The second thing was you had to restart your flipping depreciation.
That was it.
So if you had a 39-year property and you're on year 34 and the 708 technical termination existed, the last 4 years of depreciation now have to be taken over new 39.
That was a bad answer.
Oh, extremely bad.
Well, the tricky thing was you had to look at it in a 12-month period, so you could have a ownership change in 1 year and then another ownership change at the beginning of the next year, and you could get caught in that trap and you wouldn't know about it. Or you should know about it, but it was easy to miss.
Yeah, and
It wasn't on a calendar year basis.
it was awful set of rules. And I didn't understand the impetus. I didn't understand what they were trying to capture, negate, or manage by having those rules in place. Never made sense to me. Let's see. Initial basis, buying partner, initial basis equal to purchase price plus liabilities assumed. And Sam, we were talking about liabilities assumed on this $25 item over here. That's what that's talking about. The buyer takes the seller's capital account. This is partner to partner. Capital account is not changed if there's a technical termination. Look at that. There's the words technical termination. So it was post 2011 when that rule came through, based on this historical document. 754, we're going to talk about that. Steve wants to know if you have any questions. You guys have any questions for Steve on this point?
Did you tell people who Sean Miller was?
They asked.
Oh,
They asked. And somebody who went to school with him?
He was a year ahead of me in high school.
Will Miller, yeah.
did you tell him about the job he accepted after?
I did not. Go ahead.
Well, Sean accepted a job with a old friend of Pete's / client. He was moving out
Who
to,
is an absolute utter
you're being.
I don't care. Utter piece of trash as a human.
Anyway, he was moving out to Portland, Oregon. And he lived down, I think Sean lived around Dundee area, and he made it as far as 114th and Dodge. And stopped. I think he met his brother for a drink there and then that's as far west as he made it. So
So Sean had like 4 going away parties. And he asked me, Sean asked me, do you think I should go out there and work with this guy? And I said, absolutely not. You're an utter fool if you trust this guy at all. And he got that maybe from more than one person. And at some point, I think Sean got a little nervous that the warnings might be accurate and turned around. Is that
Yeah,
good enough?
good enough. You're on film.
I don't care. You can send it to your boyfriend. Let's see. Leslie, what's this say?
Recap. Any gain or loss on the sale of a partnership interest is considered a capital sale unless 751 assets, collectibles, or 1250 property is included in the distribution. Partner can have 2 separate holding periods of partnership interest, depending on what the partner contributed to the partnership and when. Purchasing partner's initial basis will be the cost he paid for the interest, plus liabilities assumed. 2 methods to close the books when a partner exits, interim and pro rata. The buyer's initial basis is equal to the price paid for the partnership interest plus partnership liabilities assumed. The buyer takes the seller's capital account.
And that's presuming it's partner to partner.
Unless 754.
Well, or redemption, the capital account would just go away. I think we'll probably talk about that. Okay?
It's pretty
So-
good. Pretty good outline, Pete.
Do what?
That's a good outline.
Oh, it's the best, Kenny. Are you talking about the last page, the recap?
No, the whole thing. That's pretty good.
Oh. It's really good. Can I get Campy back?
Did he say anything?
Yeah. Campy said some stuff, right? Was it more productive than Kenny?
Who's to say?
Who's to say? Who's going to judge?
Good answer.
99.6. Okay. Leslie, what was 99.5?
It was single member LLC. We can go multi LLC.
Single member going to multi-member. So 99.6 is the inverse. So if I'm going to say the inverse, what does that mean?
Multi going to single.
Multi-member going to single. That's what 99.6 is. Okay. Noodles, what's this say?
What are the elements of the transaction that you should analyze it for 754? A, transfer of units. B, taxable exchange or death.
Okay. I don't know why this is in here. We're going to find out. I'm drawing some sort of compare and contrast, I guess. Okay. What's this, Noodles?
All right. What are the elements of the transaction that you should analyze it for a 754? C, is it possible Pete lied?
What the fuck is this? Go ahead. And it's like this is missing a page. This has to be missing a page.
Is it? No, we go from 3 to 4.
Okay, well, let's see where this goes.
Page 1 and 2.
C, is it possible that Pete lied? D, is it possible Pete was not precise with his words? E, is it possible that most tax rules have exceptions? Good CPAs know the rules, really good CPAs know the exceptions to the rules, the nature of the rules, and how to use the rules to solve problems and create opportunities.
Okay, so the only explanation I have for this,
If we're gonna have a breakthrough on the next slide.
no, is somehow I had something somewhere that was something of this nature. This is the only explanation for what that was, because that made no real sense to me whatsoever. Is if you have A and you have B, where A purchases all B units, something along those lines that would say that would fit into this. Was there a transfer of units, taxable exchange or death, whatever, and then that would result in the 754. The sale or exchange of units would result in the 754, and we're going to talk about that. But if A buys B's units, in general, you would default to saying that's 754. Correct? Because there's two times that, two fact patterns that's going to result in the 754, I think. And what are they, Alyssa?
Partner to partner
Partner to partner
or partner
or
to partnership.
partner to partnership? Is this partner to partner?
Yes.
It is, which you would think this would result in a 754.
Yep.
But we also have a two-member LLC going to a single-member LLC, correct? And 99.6 was what?
Multi to single.
Multi to single. So now we got to figure out what it is I'm doing. So let's see what the next slide says. Noodles, who you want to call for?
We'll go Brad.
Brad, what's to say?
This is an exception to the rule. Elements of A
Oh, this is so poorly written. Go ahead.
99.6. A, this is an asymmetrical transaction. This means the buyer and seller consequences are not the same. B, this is the sale of LLC units by one or more partners where the buyer is the sole owner of the LLC. In other words, seller owns a multi-member LLC and the buyer owns a single member LLC.
Okay, so again, I must have had something along these lines that said A bought 100% of B's units, or in the alternative, C could have bought all of A and B's units. One of the two. But it starts at multi-member and ends at single member. And then there's these magic words up there which you might want to highlight because we're going to hit on it multiple times, called an asymmetrical transaction. So symmetry means that there's a mirror on both sides of a transaction. There's symmetry. So if, and we're going to talk about this for a second. Brad, I own a piece of ground. I sell you the piece of ground. What did you buy?
Ground.
Ground. What did I sell?
Ground.
Okay, so what I mean by symmetry is we transacted on the exact same thing. He bought ground, I sold ground. Asymmetrical means that I sold something and he bought something different, but it's all part of the same transaction. And we're going to put a little bit more definition about what that means because that makes no sense whatsoever at this point. But there's a possibility of an asymmetrical transaction. Okay? LLCs are default entities. We talked about this, right? Which means that an LLC is a chameleon. Do we talk about the chameleon, LLCs being a chameleon? And if it's a single member LLC goes to multi-member, it goes from being disregarded to regarded as partnership, and then if it subsequently again goes back to single member, it goes back to being disregarded, right? So single member, disregarded, multi-member, partnership, LLC with a check the box, taxed as corporation, which could have C status or S status. Single member is invisible. Everybody knows that, right? We've talked about it being disregarded. Multi-member taxed as partnership, which we talked about. LLC taxed with check the box as corporation, which we just talked about. Default status of the LLC. Pete is deemed to own the land directly. L1 owns the land. Pete and Tyler own. Okay, so evidently, Tyler contributes $10,000 to L1 for 100 units. Well, what revenue ruling do we use to diagnose this?
99.5.
99.5. And 99.5 says there's two situations.
It's he buys. What are they? Attributes property and form the partnership, or doesn't he give you money?
Yep.
Yeah.
Okay? And once you diagnose whether it's contribution or purchase units, what code section do we use after that? Kelsey?
704,
704. And what's the procedure for 704 just for the hell of it?
identify the assets being contributed.
Yep.
Make your 704 B, C an inherent gain balance sheet.
Yep, so in terms of the assets, you identify fair value, identify tax basis, you identify which partner is contributing it. Once you have that information, you're able to construct 704B balance sheet, 704C balance sheet, inherent gain balance sheet. And why do we do all that, Kelsey?
Basis shifting, or like to get things to, basis to tie.
Basis to tie. What kind of allocations do we have, Sam?
Required and agreed upon.
Okay, so does the construction of the 704B, 704C, and 70 inherent gain, is that informative? And why is that informative?
Well, we need it so then we know where the gain's gonna go once either their assets are depreciated or once we sell the assets.
Okay, so what were the three categories of assets that we had to deal with?
Short-term recognizable, the depreciable property, and something sold in the future.
Okay, and which one comes with three methods?
Depreciable property,
And what were the three methods?
traditional, curative, remedial.
Okay, and which one has a ceiling rule?
Traditional and then potentially traditional, curative.
And what's curative, what is the methodology we use in the curative method to alleviate the ceiling rule?
Well, it's if you hit the ceiling and then you buy more assets, that you can use the depreciation on those new assets.
I could not be more proud. I mean, that was actually pretty good. Kenny, how do you feel about that?
I couldn't have done it, and that was good.
Okay, I mean, that is actually, now, a week from now, if I call, can you do it?
Do it.
All right, I'm gonna do it, okay?
Let me ask this, how do we normally track whatever assets have we're tracking the gain on? What do you suggest how we track that in our work paper, so that when something is sold, 2 or 5 or 10 years from now, we know who that goes to? I have a feeling
You're not
sometimes.
asking me.
Sometimes something gets sold, and I bet 10 years from now, let's say none of us are here, and we haven't left a good track. I bet it gets missed every now and then. Is what I'm guessing.
This is what I asked you the other day, like, how do we keep track of this?
And what was my answer?
I'm not convinced you actually answered my question.
I would think in our fixed asset system, ideally,
Just put it in
Identify
the
it.
name, right?
you would think, but I don't know. I don't know how the professor recommends we do that.
Okay, so what were the three categories of assets?
Short-term recognizable, depreciable assets, and something sold in the future.
And what do we construct? What was step one, Kelsey?
Um,
Of
ide-
the 704?
identify the property being contributed.
Okay, and then, you identify fair market value and tax basis, correct?
Yeah.
And the partner contributing.
Yep.
And you construct a 704 balance sheet, B balance sheet, C balance sheet, and inherent gain. Now, do you think that keeping that 704B, 704C, and inherent gain balance sheet with respect to the long-term saleable assets, do you think having that would be, and you'd have to know who contributed what, obviously, would that tell us which property had the inherent gain associated with it, and that gain would trigger to which partner? So with respect to the long-term gain assets, it would be the 704B, 704C inherent gain balance sheet that we had to deal with, which would go forward. The short-term recognizable, which would be inclusive of, for the standard deal, the market hogs, that triggered immediately, right? So that, we aren't going to be required to have a memory, because, Stuthman, do we have to have memory for an S corp?
No,
Why?
because it's per share per day.
It's per share per day. There's no required allocations that occur with respect to an S corp, correct? But with a partnership, we're required to have a memory. Okay, so the memory that we're required to have is embedded in that 704B, 704C inherent gain balance sheet. So the short-term asset as a category is going to trigger immediately, and we're going to shove that gain to that contributing partner, correct? Is that required or agreed upon?
Required.
Required. And does required hit my 704B capital account? It only hits C. Okay, what hits by C and B?
Agreed upon.
Agreed upon. Okay, so now we've dealt with the short-term asset that converts immediately. Then we have, what was the second category?
The depreciable assets.
The depreciable asset. So the depreciable asset, we're just going to use a common sense methodology to allocate income and expense over in among our partners, are we not? On that standard, I chose 10 years to, and the remedial method to allocate that depreciation in among all those partners, and it equalized itself out over the 10 years, with the exception of the long term, correct? So, with that said, why isn't this schedule, and this schedule what you need? Because this schedule says, hey, in year one, my short-term assets convert into a required allocation, correct? Then the next lines are, well, we have an income pickup by standard of $1 million on an annual basis. And we have depreciation going to the big boy down here of 3.1, correct? So now we know that based on $2 million worth of depreciation that's in play, that's how we're going to allocate it. So now we have both the short term and where it needs to go. We now have the depreciation allocation that has to occur, and at the very end of it, this categorizes the long term, which in this case was 2 K1 interest to Four Corners and Holstone. So it equalized to 14,947. Does that equal my 704B cap account, Sam? It does. So this schedule here says what it provides me is short term of 16 million. Here's who it goes to. And remember, do you guys remember the M1 schedule discussion on this? So the M1 schedule, the M1 schedule should have a total column that says my book income is X, and then we have M1s to come down to a taxable income, correct? And then we segregate those M1s into how many categories?
2.
How many? 2. And what are those categories?
We added back like all
What-
the
what
book
are
and
the
then
two
we did
groups?
the,
Okay, maybe do that again because I don't think I'm tracking with you just yet.
because then we add back, instead of like putting them together as the like 100,000, I think it was, we added back all the book and then we did the tax amount
We did.
to break it
But
into
why
two.
why do we segregate that out?
Because the one with the inherent gain was only allocated the tax, right?
Okay, so let's make our, you're exactly right, but let's make our description a little bit more broad. We're going to segregate it into M1s that affect everybody. So the book depreciation affected everybody.
Right.
So when we had that book depreciation, and Alyssa, you and I are partners in the partnership, we would have an add back of, I'm going to call it $200 of depreciation. We would have an add back of $200 of depreciation. But you were the non-inherent gain partner, correct? Just say yes, because, and based on these calculations, you were owed fair value depreciation of 100,000 or 100. So our tax depreciation available is 100. So our global column would have an add back of 200 and a deduct of 100. That 200 would be segregated or bifurcated in between you and I, add of 100 each for our GAAP depreciation.
Yep.
And then we have a total tax depreciation of 100, deduct. Well, I get 0 of that because I'm the inherent gain partner, and you get all 100 because you're the non-inherent gain partner. So the total column being segregated out to partner by partner and segregating the M1s into, is it affecting everybody or is it just affecting a required allocation? Does that make sense? So this document to me, once you go through the process, is telling you that here's your depreciation, and then here's how you got to allocate the depreciation out to everybody to make it all work out. here's the turn in the short-term assets in the inventory, and 12 million of that inherent gain has to go to standard, 408 to Cottonwood, 727, and so on and so forth. So my M1, damn it, my M1 in the total column would be $16 million as an add. And that $16 million add wouldn't affect Osprey, Joyce, Holdings LLC, so on and so forth. It would only affect Standard, Cottonwood Ag, and those other people. So this to me is a good document. This is how I'd do it. Does that make sense, Kenny?
Yeah, if you've got a depreciable asset, but what if you got a piece of land that's non-depreciable?
I'm capturing that here.
But if that's the only thing you have, I could see how it could, let's say you only had depreciable, non-depreciable land. You didn't have a schedule like this. It'd be easy to miss.
100% it would. 100%.
I see it in fixed assets a lot where people just put it on the schedule and then make it a memo asset, like maybe only put it in book instead of the tax column.
But is that the 754 or is that a 704?
I guess that's 754.
That you're generally going to see that sort of thing for 754s, not.
I don't think I've ever seen anything labeled 704 in fixed assets.
Yeah, I guess you're right.
The easiest way to do it then is, I mean, when we have a brand new partnership or new
Right.
units being,
Yep, 100%.
then you you build a schedule when you do the tax return, essentially, that at least shows the
Hey,
assets.
Hey, what was that procedure?
Identify the assets being contributed,
And
fair market value, tax
Yep.
basis,
Yep.
inherent gain
by partner, though.
by partner.
And then build your 704B and 704C and inherent gain balance sheets. So you're saying when we have a new partnership or an issuance of units, what's the procedure? That.
So we should do that,
We should. Yes, we should.
but we don't.
We do.
Well, yeah, but you haven't been keeping the spreadsheet since you started working on standard.
No, but I got pulled in for this. Okay? So
We should have this on everyone.
we should.
Probably not.
We don't. And honestly, what's my goal?
Retire.
Well, I'd like to retire before Kenny, but I don't think that's going to happen. I think Kenny's going to beat me to the door, unfortunately. Okay, so that procedure Kenny, we spent, I bet, a day and a quarter on this, on 704 probably.
Yeah.
I mean, but you can see the moving pieces now.
Yeah.
I think. And I think you actually have a shot at executing. And the fact that I think Kenny might be slightly impressed at that exchange. Yes?
Yeah, no, it's good. I didn't know you spent a day and a quarter on it, so I didn't mean to back you up into this.
No. Repetition's great. Because the more we have this application, the more we talk about it, because every time it's a fit and a start, and it's like, what is that? And it's fit every time every time that fit and start's getting reduced and reduced and reduced, and it's becoming more automatic and more second nature, so I can retire. What revenue ruling was this?
99.6.
It was
What are you talking about? Oh, 99.5.
995. Okay. Let's see. Sale of the ground, I don't care. Okay. Assumption limited capital, fair market value is 10. Assumption C basis is 2. I think this consequence to seller, seller sells land. There's my cash, debt relief, property, 10, basis of 2, basis of 1, 9 gain is 9, associated with sale of ground. I'm assuming the next one's going to be consequences to buyer. Buyer pays 10, buyer has, so this goes back to, I'm demonstrating that there's symmetry in the transaction. The same way I was talking about there's symmetry in the transaction where Brad and I engaged in a transaction. Brad bought the ground, I sold the ground, and you have what we transacted on was ground. There's symmetry in that case. Okay? Same general assumptions. Single member LLC. Okay? So buyer buys LLC units. It's invisible for tax, so you have the exact same analysis. Okay? I think it's what I'm saying here. Okay? We talked about 741, did we not? Alyssa?
Yeah, I feel like we did.
I feel like it was very brief.
Well, it's very brief. Well,
I'm trying to remember what it was.
Brad, what was 741? Brett?
Selling partnership units as capital unless there's hot assets or
Yep.
collectibles or
100%.
1250.
So if we have a sale of a partnership interest, the sale is, it's a sale of a capital asset and 751 applies. Okay? I think everybody is okay with that. All right, well, Pete sells his units for 10 grand. What did Pete sell? Sam?
The units.
The units. Okay. 754 applies if Pete sells units, correct? We'll talk about 754. Okay. But now now I think we're getting closer to 99.6. That was me trying to lay the groundwork for what it is you had, the thought process you had to have. Okay. Buyer pays 10K to Pete and 10K to Tyler, and buyer owns 100% of the LLC, of L1. What's inside of L1 is cash and land. So, land and cash is owned by L1. Pete owns 50%, Tyler owns 50%. Buyer purchases Tyler's units and Pete's units for $10,000, and now buyer owns 100%. So, does that look exactly the same or different than Pete selling his units to buyer, and then buyer and Tyler are partners? Is that the same as Pete and Tyler selling their units and buyer owning 100%? Is that the same? So stupid question. If we go all the way back to the beginning slides, it said, I spent a little bit of time when I did this, and I think I probably did a better job than what I did today because I think our points of reference in this room are a little bit better. Why do I say, Brett, an LLC is a chameleon?
Can change form. It can be a single member LLC, multi-member, or check the box.
Okay, so if absent and check the box, a single member LLC, what is the tax consequences or result of a single member LLC?
It's disregarded for tax purposes.
It's disregarded for tax purposes, meaning the assets and liabilities that are legally owned by the LLC are owned by whom?
The individual.
The individual. Okay, and if we have two members, then for an LLC without a check the box, how's that taxed?
As a partnership.
And in that case, who owns the assets and liabilities?
Partnership.
Okay, so going back a page, 2 pages. Ah, damn it. Pete sells his units for $10,000 to a buyer. What did Pete sell?
Units.
Let's be more for purposes of this
Partnership units.
piece. Partnership, yes. Okay, and what did buyer buy?
Partnership units.
Partnership units. So Pete's gain or loss is going to be dictated under what code section?
741.
741, and he's going to have,
Capital gain.
unless we have hot assets, right?
Yes.
And buyer has an interest in the partnership, correct?
Correct.
And is there a certain election to normalize or equalize the basis, inside basis of the assets versus the basis that buyer has in their units.
Yes,
What is that?
that's 754.
That's 754. Okay? So in this case, there's symmetry in between Pete sold his units, buyer bought Pete's partnership units, and the way you have to get a basis step up is do a 754 election. So, but then you also say, Brad, what's a single member LLC without check the box?
Disregarded.
Disregarded. So that person that owns the LLC is deemed to own those assets.
Under this scenario.
Under this scenario. Yeah. So, now, what is this, is my question. Pete and Tyler sold their interest in L1. What did they sell?
They sold partnership units,
Okay?
but buyer bought the assets in the partnership because now it's a disregarded entity for them.
Did everybody follow that? Seriously?
Yeah, it changed from multi to single.
Did you follow that?
Mhm.
Well, I'm sure that you did, but for me, that was a hard concept to wrap my head around. Was that seller is selling a partnership interest, and the gain or loss on the sale of that interest or the gain or loss is still dictated or managed under Code Section 741. That the seller now has to do the gain calculation, and it's going to be capital unless there's 751 assets. And buyer bought what?
Assets.
Assets. So going back to, I sold a piece of ground to Brad, he bought a piece of ground. This is now turns into, I sold a partnership interest to Brad and he bought assets. It's asymmetrical. There's not the same thing on both sides. And that's because of the disregarded nature of an LLC in Brad's hands. Okay, so Tyler buys Pete's units. L1 buys Pete's units. These are just variations of what it is. Okay. Seller's treated as, well, you know what? Let's, I wonder if, do I actually have 99.6 in here? Is the revenue really in there? I think there's 3 scenarios under 99.6. Let's go here. We'll go do it. Do you know, Kenny,
What's your question?
how many scenarios there are under 99.6?
No.
I think you do have something in here kind of towards, it's the last page.
I do.
Yeah.
Okay, there's 2 situations. Situation 1, A and B are equal partners. A sells A's interest to B. That's 1. And then 2, C and D are partners in C and D. C and D sell their entire interest to E. Okay? So there's 2 scenarios that exist. Okay? Buyer street is purchasing assets. Proceeds 10-10, 110. Evidently, these are givens. Opening balance sheet to buyer is 10 in cash, 10 in land, and 20 of equity. Okay, so I don't know. I mean, if you guys truly understood that, I don't know. Do I need to go through these? Let's go through some. But I want to see if. We'll go through them, but here's a sheet that I have that might be worth putting a post-it on and keeping, because this to me.
I have a
is-
stupid question, Pete.
Yeah.
Anytime you're selling a partnership unit at all, aren't you sort of deemed to be selling your proportional share of the underlying assets?
According to what I'm seeing from that past thing, it feels that way.
So,
The best-
so how is it, how is this any different? I don't see that it is all that asymmetrical.
Well,
You're selling partnership units from a legal standpoint, but you're selling the underlying
But
assets of the partnership.
You're talking primarily from more the sell side. The buy side is completely different.
Well, aren't we saying the buyer is buying assets?
Under 99.6, they are buying assets.
And so the sellers are basically deemed to be selling the underlying assets. The buyer is buying
No,
assets.
you're, the only reason I'm saying I'm agreeing based on the fact that you do have under captured 1250, which evidently you might get taxed on, which blows me away. I didn't know that 2 days ago or 2 hours ago. And 28% collectibles, I didn't know that. But I did know that when you have a sale of a partnership interest, because there's nothing in there that says it's capital sale of a capital asset under 741 unless there's hot assets. Hot assets are defined by depreciation recapture, cash basis AR, and appreciated inventory. Or did I say that? Yeah. So in my mind, it was just capital. Steve Kenny's slide, along with the 8308, seemed to indicate that you now have to look through to see if there's any 28%, any collectible subject to a 28% tax rate, and you have to look through to see if there's any undercaptured 1250 and segregate that out. So that feels a little bit more like you're required to look through than what I thought just this morning. However, when you buy a partnership interest, and that's what you have, you don't have a single member LLC, the only way you're going to get a basis step up is by going through 754, a basis step up. When you buy a single member LLC, you bought the assets. There is no 754.
You're saying the differentiation is that you're buying units directly from the other partners in a 99.6 situation versus buying newly issued units where you don't get a 754 step up.
Well, the newly issued is dictated under what code section, Kelsey?
704.
Okay?
Yeah,
Because there's an issuance of new units and you have to go through that procedure of balance opening, identifying which partner contributed what asset, what's fair market value of those assets, what's the tax basis of those assets, construct 704B, C, and inherent gain balance sheet. So you can run out your capital accounts. That's what I did on the schedule. And so that's 704. And sometimes it's hard to remember just because it feels similar. I mean, units are in play.
yeah.
Which one am I dealing with? Okay, so when I figured this out, actually I figured this out in an IRS exam. It was kind of embarrassing, but whatever. Transaction A and B own A and B partnership. C pays A and B for their entire interest. From a buyer perspective, the assets were distributed or they bought it directly from A and B. I'm not sure I care either way. C is deemed to have purchased all the assets, Now this is one that you might want to put a highlight on. Since C is required to file a Form 8594, do a 1060 cost allocation, no 8594 is required for seller. The 8594 is your purchase price allocation form. So, for me, when I learned that, especially from this transaction, if I'm having a sale of a partnership interest, and it's not going to single member LLC. So Pete and Brad are partners in a partnership. Brad sells his interest to Nate. There is no purchase price allocation. There is no required 8594. There is nothing that requires us to allocate purchase price, but there is a 754, possibly. So I will require, what I've started to do is require everybody to agree what the fair value is on the balance sheet in the transfer of those partnership interests, because what happens is I don't want to be surprised by hot assets at all. I want everybody to agree that PP&E is equal to tax net book value or something today, different today, because we're in the negotiation process and we're about as friendly as we're going to be.
So when you say that, you mean have it as part of the legal document, closing
Yeah.
document?
Yes. 100%. So, it was really predicated me on working my way through 99-6. 99-6 says buyer is purchasing assets. Buyer still has to do a purchase price allocation in among those assets as if they entered into an asset purchase and the other side sold assets. But the other side didn't sell assets. They sold a partnership interest. So C's required to file the 8594 with purchase price allocation. No 8594 is required from the seller. So that to me seems pretty important. And then from a seller's perspective, they sold a partnership interest. Sale of partnership interest is capital unless it's not hot assets, depreciation recapture, portion gain, blah, blah. We've already touched on all that, right? This to me is not a bad summary of certain things that we've been dealing with. And I also say file 8308 with tax return, calculate the gain loss from the sale of the unit, but keep in mind 751. To me, this shows the asymmetrical nature of the sale of a partnership interest where it goes from a multi-member to a single member.
For the 8594, so the buyer is required to fill that out.
Yes.
Is that then what's determined what is considered hot assets for the seller under 751? So don't they need to probably file that too?
The seller?
Does it need to go in with the 8308 at all?
Nope.
Do they just have to be in agreement? Like,
They don't
before,
have to be.
or they're supposed to be?
It's better if it is. Doesn't have to be. Steve can sit there and say, that PP, I bought the interest, that PP, and Steve's the buyer, I'm the seller, and he could have Brad as his guy for the preparer, and Steve could say the PP&E pursuant to this calculation, acquisition cost, original acquisition cost of $1 million, net book value of $200,000. He could say that's worth $1 million, and that's how I'm going to construct my 754, or that's what I'm going to do with my purchase price allocation. If it's multi to single, either could be true, 754 or multi to single with an 8594. But there's nothing that's compelled us to agree. And when I would prefer that it was 200,000. So this is, when it comes to the 8594, this is a nice piece of information to have. Is that if, to Leslie's point, if you have a buyer and seller, it's better from an IRS defense perspective for buyer and seller to agree on purchase price allocation, because buyer and seller have adverse interests in how they want to allocate that purchase price. So a buyer is going to want everything into PP&E, right, Leslie? A seller is going to want everything into goodwill, right? So we have adverse interests in terms of how we want to allocate that purchase price. And if you and I are engaging in a transaction where you're the buyer and I'm the seller, and we put a provision in the agreement that says we're going to agree with 90 days to the purchase price allocation. I don't like agreeing post-deal because, again, we're as friendly as we're going to be during negotiations. So if we're going to agree, let's agree now. Okay? But how often do you see that, Kenny, in agreements?
when they agree beforehand?
No, generally, it's primarily after,
Yeah.
I think.
Yeah,
more
because
often.
sometimes you can't determine it 100% beforehand because you don't always know what the purchase price is going to be. But I mean, ideally, yeah, you agree beforehand conceptually, at least if you set adjusted tax cost value and inventory at book value, you know, you can define some terms, but it should be. So on an asset sale, theoretically, it should have the 8594 be the same numbers for both parties, but it doesn't always happen, but it should. I'm surprised the IRS doesn't match those things up more. And maybe they haven't had the technology to do it, even though they say that it should match.
So for 99.6, only the buyer has to file the 8594.
Correct.
But if it wasn't, like if it was a transaction not under 99.6, both sides are required to file that, right?
Talking about sale of partnership interest?
No, just,
An asset sale?
yeah,
Yes.
okay.
Yes, 100%.
But partnership interest, just the buyer.
Yeah, correct. So we have all these classes, right, for the 8594. Class 1, 2, 3, 4, 5, 6, 7, 8. And some of these are grouped. And class 1, I think, is cash, right? 2 is
Accounts receivable, inventory? Maybe?
one of them's kind of funky.
Publicly traded stock up there somewhere,
Something weird.
marketable securities.
I always get a little
I can
lost
never
in
remember
2 and
what's
3.
what, yeah.
And we're going to pretend it's AR inventory, even though this isn't right. 4 is PP&E, I think. And this is all goodwill, intangibles. Something along those lines. So my methodology, because what you said, Steve, was that you don't really know what the final balance sheet is, and you really don't know maybe what the final purchase price is, and you really don't know what the final balances are going to be in these particular categories. Everything's kind of a moving target. So the way I've approached that to alleviate that problem is I say equals gap, equals gap, equals, what's that? That's inventory? Equals gap. Then I say, I'm going to put a hard number here. We're going to agree on a hard number with PP&E because that's the one that can bite me. That's the one that could cause me a problem. And then I say, plug to goodwill. Because
You might nail purchase goodwill also.
do what?
Purchase goodwill could be an issue also.
It could, but you're stuck no matter
Yeah.
what. Okay, so what Steve just brought up is that goodwill can come into 2 categories. One is purchased goodwill, and one is self-created goodwill. Okay, so if I bought Steve's business for $10 million and I did a purchase price allocation, and for ease of discussion, everything went to goodwill and there was no other asset. I now have $10 million of purchased goodwill on my balance sheet. I depreciate that goodwill down to $6 million. If I depreciate that down to net book value of $6 million, Leslie, how much depreciation have I taken, assuming I bought it for 10?
So 400?
$4 million.
Yep.
Okay, so that falls into this purchase goodwill piece. Kelsey buys my business, and it's all goodwill. She pays me $20 million. Okay, so my net book value of my goodwill was how much?
6.
It was 6. So what's my gain?
And she purchased for 20?
Yep,
14.
14. So what is the character of my gain on the sale of goodwill?
So goodwill capital. Or it depends. Or
I got 2 categories. Okay,
Is it partially purchased and partially self-created?
capital. Self-created is capital. Purchased, sale of goodwill is 1231/1245. And if I say 1245, Sam, what does that mean? Character-wise. Melissa, what's character of 1245?
You recapture the depreciation.
Yeah, what's character? What tax rates is
Um, I don't know.
Kelsey? What's the character of 1245 recapture? Ordinary. So that $4 million of amortization that I took on my purchase goodwill, I purchased the goodwill from Steve for 10. I took $4 million of amortization to get to net book value of 10 or 6. Kelsey bought my goodwill for 20. So there's $4 million that's now 1245 recapture, and the gain is 1231. So that's a good call, but there's nothing you can do about that with respect to this. That just is what it is.
Well, unless you could argue you got separate businesses. Maybe the business at 10 million, maybe after you bought it, you created some other business lines. Maybe you could argue you've got,
Could.
you might, but it's something to look at. You need to be aware of it. You could possibly plan around it.
Possibly. Kenny's a better tax planner than I am, because I don't, actually, that never occurs to me. Honestly, it's all in one bucket to me. But I think you are right from the standpoint, if you reference back to, and there's only one guy in this room that's going to know what it potentially means as Kenny, the anti-churning rules under 197. Does that mean anything to you?
Yeah.
Okay? And the anti-churning rules of 197, and actually this is good to know. Actually, this is great to know. This is even in partnership wheelhouse. Prior to 1991, Steve, in 91,
Sounds about right.
goodwill, was that deductible or non-deductible?
Non-deductible?
It was non-deductible. Goodwill was non-deductible in 1991. Was non-compete deductible?
Yes, it was.
It was. Customer list?
Yep.
Yep. So there's other categories, and non-compete would be, or let's call it 5 years. Over what period are you able to deduct pre-1991?
I think it might have been over the term of the
was.
agreement. Yeah.
It was over the term of the agreement. And the customer list, I don't really remember
I
that.
think those were like 5. Yeah.
That I don't know. I honestly don't know. So pre-91, goodwill, 197 intangibles, you had varied lives that could be inflicted or used to run that off. But goodwill was not deductible. So buyers and sellers played all sorts of games, and the Congress got a little, they didn't like that. So in 1991, they legislated 197. 197 said, enough. We're going to take customer list, goodwill, non-competes.
Software.
Software. I don't even want to talk about software.
Yeah.
Software purchase pursuant to an overall asset acquisition is amortized over how long, Kenny?
I don't know, 3 years or 5 or 7, I can't remember.
15.
Oh, now. Yeah. No, yeah, okay, I thought you meant back then. Yeah.
It's 15. Where if you just buy software off the shelf, how many years?
3?
3. What the hell?
Yeah.
It's a bad rule. Have you ever done that? Have you ever capitalized software at 15?
Maybe. I can't remember. I don't know.
That's a big fat no. He is not. So, in 91, they said, enough. We're going to lump all these assets, non-compete, purchase software via an asset acquisition, goodwill, customer list, all into one bucket. In exchange for making goodwill deductible, we're making them all 15-year deductible. We don't care that your non-compete is 3 years. You're still going to have to write it off over 15 years. It was kind of an exchange. So the IRS got paranoid that people were going to play games with respect to goodwill. So Steve Kenny has goodwill from 1991 or 1990. They were afraid he'd sell it to himself somehow, something, and start to amortize that. He'd get capital gain on the goodwill, and he'd start to amortize it and get ordinary write-off. And they said they created these rules called anti-churning rules that said if goodwill existed prior to 1991, it's still not deductible. Does that rule still exist today, Steve?
It
does.
I don't know.
100% of it does. This should be legislated out of the system. So if the question that you have to ask in a business acquisition is, did this business exist in 1991? And if you buy that goodwill that existed in 1991, it's not deductible, even today. It's a bad rule. So, one of the things that you can do, as stupid as this sounds, is if Steve Kenny is a sole proprietorship and he had his business that started in 1990 and it has goodwill, a fair value of $10 million. And I buy that from him based on what I just said. What's my amortization deduction, Sam? Nothing. But Steve's got a good tax guy named Adam Austin. And he says, oh, no, Pete has a good tax guy, because I'm buyer. So I asked Steve, I say, Steve, will you put your goodwill into a partnership whereby Steve and Julie, his wife, get that little giggle back there. Who's met Julie? Oh, she's a peach. You wearing your spiders? She makes fun of my clothes all the time. So now
To be
the
fair,
goodwill
to be
resides-
fair, a lot of people do.
Shut up.
You look good today.
I dressed for you. Have you guys heard about the spreadsheet? You want to tell them about the spreadsheet?
No, I'd like to hear you talk about it.
No. All right, I'm going to go back to my... So he stuffs this goodwill into L1. And Steve and Julie are now husband and wife. I can partner with Sam. And Sam and I... Pete buys Steve's interest, and Sam buys Julie's interest in the partnership. As stupid as this sounds, this is stupid. I can't buy the goodwill directly from Steve, but I can have Steve stuff that goodwill into a partnership. And then I can buy the partnership interest. And then I can get a step up under 754. So what I can't do directly by buying the interest, I can put it into a partnership and get the step up via 754.
Have you done this
Yes.
recently?
And it then becomes deductible also?
Yes. Yes. Within the past 5 years. And actually, Shafford, I was trying to think through a problem, and Shafford's the one who goes, there's your solution. I'm like, motherfucker. Because he got there before I did.
Must have been a big number to do it.
I can't remember. It's been within the past, if I say 5 years, it probably means 10.
Could you segregate that goodwill and say, here's what it was at 1990 and here's what it was in post 1990 and just put it in two different buckets, or it all has to go together?
It goes together. But what you could do, and this, I can't remember who the client was. I don't care. I almost have it, so it's almost right there. He drinks Grey Goose. He's Weeder's friend. He's hopped around to a bunch of places. Whatever. We fucked this up.
Montreff?
Got it. Yes. He got it off Grey Goose, Weeder's friend. That was a hell of a game.
Narrowed it down to about 10, yeah.
Okay. We screwed this up. And I can't remember.
Is that Carlson?
Yeah,
Okay,
it was.
I remember that now, okay.
And so the way I can't remember, but we tripped over these rules. There was goodwill that was not deductible. We tripped over this rule. And I don't remember the fact pattern and how we tripped, but we in fact tripped. So part of what we were trying to argue was, well, embedded in this 10 million, we didn't call it goodwill, we called it intangible. And what we had before that was the 10 million in intangible. We said, how many categories were there, Kenny? Not compete, customer list, and there were other items that were deductible pre-90 or pre-91. So what we argued was, well, this goodwill is 100,000. Everything else falls into those items that would have been deductible pre-1990. That's what we tried to argue. The growth was in those other items, not in the goodwill. Because you can't say the goodwill that existed, this is my impression, I'm pretty sure I'm right. If there's $1 goodwill in 1990 that grew to 10 million, it's all bad. You can't say the growth of the goodwill post 91 is something that was deductible.
Did the IRS come back and say like, no, you can't do it that way, or how did they figure out?
It was an IRS. It was the client was selling, and the buyer identified this as a potential tax risk, and they didn't want to. They wanted an indemnification, an escrow, and other things for our screw up. Is how that unfolded.
Workforce was another category.
Yeah. So it's good to know that it's a good question to ask. If you're on the phone, how old are you, Brett?
25.
25, and you're on the phone with, somebody that's my age, that's my age or Steve Kenny's age, that's an attorney, and that somebody's buying and selling a business, and you're astute enough to say, did this business exist in 1991? And then they say, why are you asking? And you say the anti-turning rules, goodwill could be a problem. They will fall out of their seat. That is knowing something that most people don't know. And if on the one off chance you hit it, they're going to be impressed. Wouldn't you be impressed?
Yeah.
Yeah. How did we get there? Purchase price allocation, difference between purchased and not purchased goodwill.
Are you gonna talk about your spider sweaters now, Pete?
No. You can if you want. You want to, just go ahead.
Well, Pete's expanded his wardrobe the last couple of years, but for a while he had 4 or 5 quarter zips that he wore, and Sam and Eddie had 1. So I don't know, for a period of 2 or 3 months, I kept track of what they were wearing
On a fucking spreadsheet.
on a spreadsheet. And then I gave him the spreadsheet, but I also bought him some new Lutz gear because I thought they needed a little variety. Anyway, they didn't. Pete, actually, you had a good sense of humor about it. Sam was offended. But I think his wife was happy that he had something new to wear.
Kenny, I have known you since 1997. Is that right?
Sounds about right. Is that when you got married?
No, 98.
Oh, okay.
But you were the same knucklehead at Christmas parties that you are today. So we crossed paths at our Anderson Christmas parties. And
So we tried to hire Pete's wife, Peggy, first.
here we go. He's gonna get
Because I
stuck
used to
into
work with
this.
his wife and Arthur Anderson. So we tried 4 or 5 years to hire Peggy. We couldn't get her, so we hired Pete.
Is your wife still in accounting?
Mm-mm. Once we had our first kid, she stayed home. You want to tell them the decimal story while we're at it?
No.
Why not? Actually, being stupid, you can dig yourself out of being stupid. Can you not?
Yeah,
Am I a living example?
you had a bad start at Lutz, but
He thought I was the dumbest fucker on the planet. They got an absolute bill of goods. 100%. Am I overselling that?
no, yeah, you're right on.
You want to tell them what happened?
No, I like your version.
I reviewed a tax return, and somehow, when I reviewed this tax return, somehow I thought $40,000 worth of state withholding was $4,000. I didn't catch it on review, so my Schedule A deduction was $4,000. The withholding on the state was $4,000. And here's something that you should know about Steve Kenny. And this is another reason, if I never have to review another tax return, it's going to be fine by me. There's nobody, I kid you not, nobody in the building that's going to bust a tax return faster than Steve Kenny. And I don't know what superpower he possesses to do it, but he, like that. Adam,
Fair.
he just has the ability.
Holtzman never makes mistakes.
Well,
That's debatable.
let's keep that streak alive. So Kenny calls me and says, "Hey, this is wrong. $4,000. Not, it should be 40,000. Oh fuck. Okay." So I get the return back and I give it to Mark.
Blair?
He went to Conagra. And Mark Blair changed the return. I get it back. I look at Schedule A, and my tax went up by $36,000. Everything should be good. I ship it back to processing. Steve Kenny calls me, and he is not happy. What the fuck? What do you mean, what the fuck? He goes, "You didn't change withholding." I said, "Yeah, I did." He goes, "It's still $4,000 on Nebraska." What? So what Mark Blair did was he changed it on Schedule A. He didn't change it on the W-2. He changed it on Schedule A versus the W-2. And when I saw it was changed on Schedule A, I didn't go look at the state return because I thought I was good. And Steve Kenny literally thought, I think, I was the biggest bust on the planet.
I was a bit underwhelmed, but it's made a lot of progress. But point is, everybody, even though Pete's the professor and teaching all these complicated concepts, I mean, everybody makes mistakes. I mean, I do every day. We all do. So, but you learn from it.
Yeah, but I came out of the chute hard.